The S&P is on pace for its fourth positive week in 5, with new all-time intraday highs, as investors bet economic weakness later this year will lead to those cuts. Our next guest says what matters for long-term investors is whether those recession fears become a reality. Let's bring in Brian Jacobsen. He's the chief economist with Annex Wealth Management. So, Brian, it seems like no matter if people are split on the question of downturn now or later or whatnot, they all seem to agree the Fed should be cutting here.
Well, that does seem to be the case. I was looking at X and then on LinkedIn, and everybody saying about, let's just get on with it as far as the rate cuts. But the Fed wants to be incredibly cautious. They feel like they can. But by cautious, I think that just means that come September, they'll be in a position where they'll be able to start confidently cutting rates, probably at an every other meeting clip. Now, if they do that, I think that we can avoid a recession. We do know that manufacturing has effectively been in a recession with an ISM manufacturing index below 50, 18 out of the last 19 months. The breadth of job gains there has been very narrow. And so some parts of the economy have already gone through a recession. It really does seem to us that the Fed, they can really pull this off as far as avoiding an actual broad-based recession, provided they do start cutting come September.
So in that context, what do we say about markets? Do we say that the kind of narrowness of the leadership and the fact that the top, stocks are 37% of the market, is that a reason to be concerned that it's masking an underlying slowdown, or is that a reason to be excited about the prospects for AI? What do you think?
Yeah, I think that's exactly right. I think that the strength of the top names has really masked the weakness underneath the surface. We did have, if you look at the Russell 2000, effectively another earnings recession. You've had not just a double dip earnings recession, but almost like a triple and quadruple dip earnings recession over the last few years, if you count it as being 2 consecutive quarters in a row of declines in earnings per share. If you look at some of the other sectors as far as the decline in the earnings, really, there has been an earnings recession kind of rolling across the different sectors and sizes. It's been the big boys that have really kind of carried the day in terms of earnings and also with the price action. So if we do get the Fed beginning to cut, avoiding that broader based recession, you could see a decent junk rally from this point forward. But it all does hinge on the Fed changing its tune.
I want to turn back to inflation a little bit. Inflation has come down, but prices really haven't so far. They are still above where they were. Do you see a scenario under which prices could actually decline if the economy slows and companies have to discount to attract customers?
Yes, I think that is maybe one of our more out of consensus calls, though there are others who share that view, is the idea that if we do get this slowing, we are already seeing consumers fatigued with these high prices. There's already reports about how back to school shopping discounts are going to probably start next week already. So price wars are beginning. We've already seen it as far as with the goods prices information, that with the most recent report in the PCE, those prices are down about 0.1%. year on year. When we get the CPI numbers next week, we'll probably see that trend continuing. Granted, it's mostly in durable goods, not necessarily in non-durable, but you could see that begin to widen and get a little bit deeper. And then with service sector prices, that's really the part that you've seen the positive inflation. But even that could begin to slow as we see those market rents begin to feed into the way in which the BLS calculates the owner's equivalent rent number.